over the last 3 years, there are so many deals that should not have been underwritten. I know they have painted lipstick on that pig and they're projecting blue skies on everything. So buyer beware.
In this episode, I talk with DL Campbell. DL is a commercial real estate investor and developer with 19 years of experience. We discussed how she got into land development and commercial real estate, the benefits of land development over value add projects, risk mitigation, the market, and things that passive investors should consider before making their next investment. I hope you enjoy. Now onto the show. How you doing, DL?
I'm great, Chris. How about yourself?
Good. Appreciate you coming on the show. Really like to have folks, I really enjoy talking with folks who have been in the industry for an extended period of time. And by extended, I mean more than like the last 3 to 5 years, because real estate's been really hot for the last 3 years or so. But if you want to even look at the last 10 to 12 years, it's been really strong ever since like the 2010, 2012. For the most part, we haven't really seen a rainy day. People have been in business much longer than that. You've been through a couple things, been through a couple cycles. And
yeah, this white hair doesn't come from nothing.
I'm getting a few of those myself.
Yeah.
So let's start out. How did you get into commercial real estate and development?
Sure, absolutely. In 2005, I started to see the writing was on the wall. I was working as an engineer, corporate America, and I saw a lot of third parties coming in. So I thought, hey, I need to diversify. While my career is awesome, I need to diversify. And so I started taking all kinds of courses to see where I wanted to fit in. And commercial real estate is very logical. So it's how I'm wired, very logic driven. And so it was a good fit for me. 2009, I picked up my first commercial property. It was a small apartment complex in East Dallas. And I forced 80% vacancy because I still had my job. And I did the rehab and I re-tenanted and I doubled the property value in a year. So that's where I started. I've done value engineering, acquisition services, all kinds of logical things in the commercial realm. But for people who are more people oriented, there's also a lot of options in the commercial world where you can get into the leasing part or the design part and the creative part as well. So I like that.
Nice. And so for commercial, because that can mean a lot of different things. You mentioned multifamily starting out. Is it when you talk commercial, is that primarily what you're investing in?
Right. So that's a great question. And there's a couple of really good sources that have good training right now, not how to syndicate, but NAIOP.org, NAIOP.org, and also ULI.org. I'm leading people to those websites if they want good commercial training. So commercial can be office, which you never want to be in. Light industrial.
It's not right now.
No, well, and it's, if we look at it, office has been soft for the last couple decades. So it's never really been a great investment opportunity. I know some people who have lost money, unfortunately, in waiting for an office build. And that's, they're trying something different other than Class C or Class B multifamily conversion. They're trying a different asset class. So I take my hat off to them, but not office, never office. Okay. Light industrial, storage, retail. And so when we're talking about these different asset classes, we want to make sure that we're keying into a good asset class that is recession proof. And not that multifamily is my favorite, but I get to be on the build side, and that's logical. And everybody Chris needs a place to live. So it's secure. We're sticking with Class A luxury, garden style multifamily, and our tenant type is the single young professional, basically in their 30s, building their career. So that asset type is recession proof, like we've seen in through the pandemic.
So you turned that one multifamily around, and how large was that? How large was that one? Your
It
first one?
was not big. It was a bite size. It was about a $500,000 property.
Okay. Well, depending on where it
So
is, 500,000 could be that could be a fourplex, or it could be maybe a 20
right
unit.
now, you really can't. Yeah, you're right. We really can't depend on values. I actually ended up falling in love with the tenants there, and I didn't expect that. I was going to flip it after the first year, and the Lord had a different idea. So I stayed, and I got involved with anti-trafficking and anti-abuse, and we had helped some people to stay on the property to get out of those
Oh, wow.
situations.
Wow.
It was a different turn for me, but and then I have worked on other acquisitions for retail centers. On our website, we have a Starbucks we worked on, and phase value engineering to take a lot and get more units on it for retail centers. So all of that scope as well.
Yeah.
Right now, we're building a 450 Class A luxury multifamily units, a garden style, and we're in the hottest market, of course, Dallas.
Yeah. So how did you go from small
Question.
multifamily to development of a 400 unit? Like, how does that transition go? I mean, it probably didn't happen overnight. I know a lot of folks that they like to stay away from development. I mean, there's no cash flow, but there definitely could be some. It can be very rewarding on the back end. But a lot of investors, when they say, "Hey, I'm in multifamily," they're probably talking about value add or core plus, which is more of a cash flow play. These are performing assets that they're already leased up, and they'll go in and maybe update rents and management and whatnot. But you're doing new development. How'd you make that
Well,
transition?
that's a great question, because what we're doing is we're forcing value on the land. On the land development play, you're forcing value on the land. So some of the construct for finding a great deal is the same. Like I found an off-market property in the middle of Dallas. That is unheard of. People are going to Houston, which is a marginal market, or other places because they can't find an excellent deal in Dallas. So the Lord led me to a great deal. There are certain aspects where you need to be careful and learn what to look for. Like you need to have your zoning in place and 12 utilities on the lot. But rather than going in and forcing value on an as-built conversion, see, the issue with all of these properties in the last 3 to 5 years is that they're doubly appreciated. And we don't buy commercial property like that. We buy for the cash flow. On one hand, we buy for the cash flow, and on the other hand, we buy for the appreciation. And while there has been some margin in cash flow, there has been no room for value add appreciation. And we're starting to see it. And unfortunately, it's tanking the market because a lot of the people who came in the last 3 to 5 years, they think a 2% interest rate is normal. You know, we we knew that the interest rates needed to normalize, and so we have lots and lots of buffers built into our formula. So we never buy on just cash flow or appreciation, and that's one of the problems that I've seen in the market with people learning is they're buying with absolutely no appreciation. The only place for that appreciation to go is down, depreciation, and then they're losing their value. Then they have a loan that they can't pay. And then if it's a class B or C, there's only so much margin that you can force those rents on where to go. So when those rents go down a little bit, the only play that they have really is in those rents, and their profit margins are diminishing.
Yeah, because commercial real estate, or especially, or it's more the commercial loan products you have. So, say you were talking about only buying on appreciation or only buying on cash flow. Both is obviously what you really want. Cash flow definitely pays the bills, but you need appreciation because that's your buffer. But at the end of the day, unlike single family, where you can get a 30-year fixed, 15-year fixed, or whatever, the bank doesn't care what your debt coverage ratio is. But in most markets, when you buy and you've got your spread, your cash flow, it's probably not going to change a lot over the years. Not so much with multifamily, because even if you were to get fixed rates, which is uncommon with commercial finance, it's typically fixed for a 3, 5, maybe 10 years. It's very uncommon to get like 30-year fixed. Even
Yeah,
if in those situations where you have it fixed, when that fix turns variable, or due to market circumstances like excess inventory coming on, pushing rents down, or whatever, the bank or operating expenses skyrocketing, like taxes, insurance, material costs, because that's happening. The bank wants to see, hey, what's your debt coverage looking like now? And once it falls below a certain threshold, then they're going to start bugging you a lot more. And worst case, pushing some buttons to get you to perform, or worst case, take over your project. But it's very different. You're looking for both. You're looking for
only
appreciation and
both.
cash.
And people aren't teaching that. Unfortunately, the gurus, we're owner operators, we're not syndicators, but the gurus are teaching, buy on either. And we never do that. We buy on both. And where are we going to find those deals? Probate office, all the things that we know, but we have to think about talking to a probate attorney, somebody trying to get out, maybe a second generation, trying to get out of properties that their parents worked so hard for. They usually will sell. Divorce court, divorce attorney is good for finding deals on the courthouse steps. And it's not all about sitting behind the computer and looking, although I did do that to find our deal. The way that I found this off-market property is I was analyzing properties to the north of town and to the south of town, driving back and forth. I was driving everywhere, as well as doing the online research, driving for dollars. And I saw this little sign, and it is a seller's sign. So we ended up in a seller's market, tough market that we're coming out of in the next year, and ended up with an off-market property. We've been able to nearly double the value in a year. And that's the goal that you want. Same thing with those apartments. I doubled the value in a year. And we're forcing value on the land by working with the city, working with the county, and getting our entitlements. We're 90% entitled. So our property right now it's worth at least double. And then when we get entitled, we'll take that equity in the property and we'll take it into a construction loan. It'll be 3 times the value at that point. So we're just forcing value on the land on a development deal, just like any other off-market deal that you can find. You really, in order to get a good deal over the last couple of years, you should have gotten an off-market property and use those other tools that we've been taught before to get that smoking deal.
Yeah, because ultimately the best deals that you get are when they're calling you, or when you're the only one calling them, which in that case is usually off-market direct to owner. But it's a little bit more challenging. I mean, with single family, very common. Like I'd say 90% of all of my deals were direct to homeowner. There were a couple through a wholesaler, and maybe two or three were on MLS. I just never really did that. And then a couple referrals from realtors.
Yeah.
With commercial, especially large commercial or large multifamily, a lot of them are almost probably exclusively are through brokers. But there are direct to owner transactions, and it's probably the good old boys club where they just really know each other and they know you'll perform. Any thoughts there?
Yes, absolutely. You're right on that, Chris, because a broker is not going to call you back unless they think you're at the top of the list to close. And they have their buyers that they know will close sufficiently quickly. And so that's where those pocket deals are going to go. So what I did 1,000 years ago, 19 years ago, is when I was talking to brokers, I would email them first, and then I would have a chance to think about what I was going to say. And because otherwise, they'd ask me something I don't know, and I'd be like, I'd be found out. So you have to work your way into it. That's why I did a lot of training, a few years of training before I took on my first property. And also, if you have a deficiency or a disadvantage, I would say a disadvantage. I changed my name to DL Campbell a long time ago when I was working as an engineer, because it just levels the playing field. They get an email from DL Campbell and they'll reply, Dear Mr. Campbell. I'm like, all right, good. So
I see what you did there.
I just have to work it out.
Yeah. There was a guest on a previous podcast. He shared a good ninja trick on how he worked with brokers, and that was being very new in the industry, not knowing really what to do, what to ask, not knowing anyone in the market that he was wanting to work in. He called brokers in a completely different state and different market because he wanted to ask them all questions, and then he realized what they wanted to hear after screwing up 5 or 10 or 15 of them of the conversations. Eventually, he realized how to engage in that conversation and the way he needs to approach them and how to answer their questions, so he could go into the actual market that he was interested in and not blow his opportunity. I thought that was a really creative way of practicing when the stakes are low, so that way when the stakes are higher, you've got some reps in.
Oh yeah, that's excellent, Chris. It's because you don't want to blow away those brokers. It's a very small group, and it has been really hard to get sellers brokers to return calls or emails or anything for the past couple of years. So I just had to double down and drive. I was looking on the MLS. I was looking on Realtor.com. I was looking on even the trash of LoopNet, CoStar, and I was doing a lot of research online. But I was also driving the miles, and it was really tough for even a seasoned person to be getting responses back from brokers over the last couple of years. We were just blessed to be led to this property, really.
Yeah. Market balance is coming back. So, sellers, brokers they're a little bit more eager to have conversations now than they were last year. What are your thoughts on the current market?
Well, there's a lot going on, and I'm trying to stay out of it as much as possible. I'm going to uli.org to find the market trends, and we just had a really good update on the market yesterday that was pretty positive, very positive on the multifamily side. Retail is okay. It's going to be okay. Industrial is going to have a challenge because it's overbuilt, and office has been soft for decades. So we really had a good market update in terms of unemployment, and also in NAIOP has good training. CBRE has some good trending. So what I've done is I've been staying away from those syndication seminars that are telling people to buy anything, no matter what, and going with more of the industry standard, professional organizations where I know that, like, I have all the knowledge, but I've put my guys through the ULI, the Urban Land Institute training, because they have good foundations of commercial real estate that a lot of these syndicators are not teaching. So I think that's the biggest problem is knowledge base. There's a skill set gap over the last 3 to 5 years, and it's causing a lot of uncertainty and havoc in the market. On the flip side, what it's doing for our deal is the lenders are seeing our ultra conservative underwriting, and it's shining so brightly. So even with interest rates rising and banks closing and that uncertainty, investors have pushed the pause button in some cases. Our investors, because our deal is conservatively underwritten and profitable from their standpoint, they are actually coming back in to strengthen their positions and increase their positions. So there's both sides. There's a lot of stuff going on, a lot of volatility, but it makes our deal or any of your off-market deals, it makes them shine because they're much, much better.
Yeah, and in market volatility, there's a flight to quality. I mean, some may pull back and panic and just kind of hold off, and then others they want quality. Your blue chips, if you will, class A, as far as real estate's concerned. So it seems like that's what you're seeing.
Yes. So what are you all working on right now?
We're primarily focused, or at least our fund is primarily focused on workforce housing, cash flowing assets in strong markets that have long-term projection growth with, and this is the biggest paramount, very experienced operators. So,
Yes.
and these are operators who have been in business for much longer than the last 3 years. So like what we're doing one right now in San Antonio, where they've got 40 years of experience, 3 billion something in transactions, and there's institutional backing in the billions. So and it's class A. So those kind of assets are what we're focused on, and ultimately what I encourage investors, passive investors or operators, that if you're going to work with someone, definitely really underwrite the operator, because anyone who's started real estate in the last 10 years, for the most part, they have not experienced cloudy skies or turbulence. There's been some hiccups here and there and local, hurricanes, you may have storms, and then there was a pandemic. Those things are real, but by and large, it's been a pretty strong macro market. That's not the case anymore. Clouds are brewing, recession hints seem like they're always being whispered and getting stronger. We just don't know. I personally am very bullish long term on residential real estate, but there are short term challenges that operators are going to have to overcome. Costs just skyrocketing across like in double digits year over year, like taxes and insurance and materials and labor, utilities. Then you have debt. I mean, that's the biggest, probably one of the biggest challenges. How are you financing it? You doing bridge? Is it floating rate? What kind of caps you buying, and how much are those caps costing you? And then of course you have the local market and the demographics and whatnot. So we focus on really strong operators in great markets, strong assets. And ultimately, everyone needs to be doing that. Underwrite. I think, and because we talked about a deal that went bust. It was a portfolio in Houston. Very unfortunate. And I didn't know that operator. I don't know them. I've kind of heard some of the rumors after the fact. But at the end of the day, what I hope comes out of that is the passive investors, the LPs, that they take on themselves more personal responsibility to underwrite the operator and not chase IRR. There's a lot of operators, investors out there. They'll look at 3 or 4 deals and be like, 15, 16, ooh, 20,
Mhm.
20 IRR. Yeah, I want that one. And it's it's not that simple. And it's really dangerous.
It is. And the limited partners or the passive investors don't have the underwriting experience. And if it's a syndication, the deal sponsor doesn't have the experience either. They haven't been through a couple decades of market cycle. So there's a couple really good key points that you mentioned. And we like to say you underwrite the horse and you underwrite the rider. That's the team. And if a property doesn't have an excellent team, you gotta team up with people who do. Even if you have to give away a larger portion of the deal, you want to be able to sleep at night because your investors are getting paid well, and they are also safe and they're secured by the collateral of the property. So we want to do that risk mitigation in a number of ways so that the investors are safe.
And
With
can I add something to that too?
Yeah, absolutely.
When investors are looking at a business plan or an opportunity, and they'll see the management team, the sponsor team on the business plan, the PowerPoint, and it'll have some probably well-known faces. And there's
Mhm.
usually a couple of faces on there that they'll tout their experience. They should have that, but ask their level of involvement in the deal, because there are some organizations, coaching groups, and all that will lend the primary coaches or mentor lend their credibility
Mhm.
to help close a deal, but their involvement is very little and maybe even none outside of helping get it closed.
Mhm.
So the last thing that you want is thinking, hey, there's someone on here that's got 20 years of experience and they have 3,000 units under management. Wow, they must be a good operator, but they're not the one doing it. It's the other guy or the other gal who they just started a year and a half ago,
Mhm.
and they're really really green. So, and it's not that deal couldn't be good, but bad operators can ruin a good deal. So
Or
what we do,
or
I'm
or
not
they
opposed
or
to.
it's not a good deal, or it's just not a good deal and it shouldn't be done.
Yeah,
I
there's that
agree
too.
with everything that you've said because there are very inexperienced people who are ruining the investment market, and it's concerning for the investors. So, listening to what you're saying is so important, is to drill down in there. And it's not about familiarity and recognizing somebody at all. I think that the bottom line is that over the last 3 years, there are so many deals that should not have been underwritten. The interest rate hasn't been at 2% or 3% for a very long time, and it stayed too low too long. So anybody new in the market said, oh, anybody can do real estate, this is easy. But what about when that interest rate normalizes at 5% or whatever? So we have to be underwriting our interest rate when it's not 5%. We have to underwrite it too high. We have to adjust our gross operating expenses too high as a buffer. We have to have our inflation rate at 3% or 5%, not 6 or 8 or 20%, because that overvaluates our property. The way that we underwrite our deal, and we have underwritten the Prestige, is we have 5 or 6 places where we've mitigated risk. And we said, okay, what if everything goes wrong? How will the property operate? And as a former engineer, I have to give the property a little bit of credit and go, okay, on the rents, we're going to go medium to medium low. We're not going to go, we're not going to project high rents. And so based on those numbers, that's where we get our IRR. But any other deal, I know they have painted lipstick on that pig and they're projecting blue skies on everything. So buyer beware.
Yeah,
you
and
know.
unfortunately, some of those will come back. I think banks will probably be a little bit more willing to do what they can to negotiate before just taking back in mass, having learned from 2008.
Yeah.
But they'll take them back if they need to, or if they have to. Now, for newer operators, this doesn't mean you can't do deals. It just means like if I'm going to go do a new development deal, especially Class A, new development, prime area, I'm just not going to go try to do that deal myself. I'm gonna call UDL or someone that I know that knows that market and that type of exit strategy, and we're going to work on that from the JV perspective. And I'm gonna take a
Yeah.
back seat a little bit and learn while swinging a hammer, learn while operating. And as you go along and get a few of those under your belt, then even though you still might be green because you're only 3 years in or 4 years in, that's experienced, but it's also experienced enough where it could be dangerous. That's when you can start hiring.
Yes.
You can hire not the entrepreneurs like us. You go
Yeah.
hire someone who has an incredible experience in asset management, project management, property
Yep.
management, capital raising. You can hire those A-level players to join your team, and then that helps solve some of those credibility gaps. And then you can start
That's exactly
growing.
right.
Play the long game.
You're exactly right. And that's what we've done at the Prestige is we have 402 years of commercial and construction experience. And these people are sharp. They have industry experience. It's that credibility gap for somebody who doesn't have the 20 years of commercial, but it's also that knowledge gap because my morning was spent with our civil engineer, our general contractor, and our co-developer, and we all and our certified arborist to solve this issue. And it is so fun to be in that kind of room where iron sharpens iron. So just like you said, we're solving that credibility gap, but we're also solving that skill set gap. And the skill set is what has been missing in this market for a couple of years.
Definitely. Well, yeah, I think we unpacked a lot of notes there. I had several questions, but they actually all came out in that back and forth conversation. We did really well there. In closing, I asked the same 4 questions to everyone, and just kind of starting off here, if you could give advice to your 20-year-old self, what would that be?
Don't worry, be happy.
It's a good one. Yeah. Ultimately, it's not worth
Especially for
doing.
us logic driven people, we're good at seeing gaps and that's our skill set, but also we need to schedule in some fun. And so I have to correct myself and schedule that fun time in with family and with friends.
Love it. What book or books have greatly influenced your life?
Oh my gosh, great question. And so many books. You have from Think and Grow Rich by Napoleon Hill to The Speed of Trust, the sequel from Stephen Covey. And I like that book because I'm like, this is my personality type. It's like, let's get it done, let's get it done. But he talks about slowing down to speed up. And we're dealing with people, not machines. So the speed of trust is that if we slow down a bit, we can gel and move forward together more efficiently. So I've learned a lot from that methodology.
Love it. In the last 5 years, what new belief, behavior, or habit has most improved your life?
I try to do a really good job at being the best that I can be. It's kind of a game. It's not a competition with other people. So I try to do all that self-work and education. But I would say prayer has been the most helpful, and especially in recent weeks when some days are very tension filled and they're not very peace filled, Chris. And so if I give space for God to make his move and sit at his feet, good ideas come. And sometimes all you need is a good idea. It's like, oh, that's what I need. This is the person I need to call. this is my next action. And it really is great for stress relief as well. I'm such a doer that it takes effort for me to sit, for 10 minutes and read some scripture or something. So I have to work on it.
Love it. How can people reach out to you?
Yes, our website is honorswaygroup.com. We also have educational videos at our YouTube channel, Honors Way Group. And our current project we're very excited about is the Prestige at mayhill.com. So I appreciate your carving out time in your busy day, Chris, and let us know how we can be of help.
This was fun. Thank you so much for coming on. Thanks for tuning in. If you got any value out of this at all, please like, comment, subscribe, follow. I'd love to hear from you. And for more real estate related content, market observations, upcoming events, you can go to investedx.com and subscribe to our weekly newsletter. I promise you won't regret it. Thanks again.